Hi and good afternoon, and welcome to this Inenco webinar titled How Best to Manage the Energy Price Challenge, which is being held in association with the monthly IHE magazine Health Estate Journal. My name is Jonathan Bailey, I'm the editor of HEJ. As Inenco very rightly points out, no one can have failed to notice the impact of rising energy prices over the last year, and with NHS budgets already more stretched, dealing with the impact of energy prices at historic highs and the lack of budget certainty has become a major challenge. In today's webinar with Inenco, a leading energy management and sustainability consultancy, the company's Associate Director of Procurement, Stuart Lee, and Senior Consultant and Chartered Energy Manager, Dan Pardesi, who's attending very kindly today in place of Head of New Business, Jordan Rassus, who couldn't make it, will look to help attendees gain a better understanding of the dynamics of the energy market, and in particular, what is currently happening in the market, why are prices so high, what might happen next, how best to mitigate the impact of rising prices, and what factors to consider in shaping the right energy trading strategy. With a 54-year heritage, Inenco claims to be one of the longest established energy management consultancies with, as it puts it, the experience and insight that goes with navigating the impact of the Middle East wars in the 1970s, market deregulation in the 1990s, and the global economic downturn of the 2000s. This promises to be an invaluable session to help delegates better understand and respond to one of the most pressing issues facing NHS estates teams. During the webinar, please do type in any questions you may have of the speakers using the questions tab, which you should see on the right of your screen. And at the close of the presentations, I will put as many of the questions as I can to our Inenco hosts. I'm sure you'll find this an interesting and informative session. Dan, over to you, and I believe you're going to say a few words by way of introduction.
Today we're hoping really to cover how have we got to this position with prices? Will the prices remain high? What's going to happen next? Admittedly, nobody has a crystal ball, but what do we think might happen next? And how can we best mitigate the rising cost impact? And to talk about really how do you develop your procurement strategy to best achieve that result? So, just by way of an introduction before we get into the nitty-gritty, just to introduce Inenco really as an energy consultant. We are the oldest energy consultancy in the UK, and we've been around for over 54 years now. So we were established in 1968. As Jonathan rightly pointed out, we've operated through several major energy crises, whether that's the miners' strikes of the 80s, market deregulation of the 90s, and indeed Stuart and much of the team on our trading desk were in place throughout the 2008 financial crash and the impact that had on the markets too. We help our clients manage about £5.4 billion worth of electricity and gas spend each year. But we also support our customers to manage water and increasingly help our customers to decarbonise and move forward on their journey to net zero. As an organisation, we were actually established, first of all, to help manage energy invoices. And we process about 1 million invoices each year. And we found through that process that about 1 in 5 invoices has a mistake on it. And we recover about £11 million worth of savings for our customers each year in going through and checking those invoices and resolving errors. We've got a team of around 300 people who work directly for us, primarily out of our offices in Lytham on the Fylde coast, but also all around the UK. And we have around 550 corporate clients, both in the public sector, specifically in the NHS, but also across lots of other major energy users who you will have heard of, several major retailers, high street supermarkets, commercial real estate organisations, and major manufacturers who all really need to help purchase and manage energy in the best way that's possible for their business.
Thanks, Dan. You obviously have a very interesting client base that you deal with at Inenco. Thank you for the introduction. I think it might be helpful if you could firstly talk us through what some of the major factors have been that have impacted the energy market over the last couple of years.
Sure. So just to give a brief market update, if we look at perhaps going back even further than is shown on this chart, the market has typically operated in 4 to 6 year market cycles. And the last market cycle that we saw started in around 2016, peaked in around 2018 when we had the beast from the east, all that cold weather and snow that lingered around for 3 to 4 weeks. And then coming into 2020, prices were coming down. We were seeing the end of a market cycle. Add to that, obviously, in early 2020, and we were starting to see COVID spread all around the world. And of course, in March 2020, we went into lockdown. Lockdown meant that, in effect, demand evaporated off the grid. So essentially, other than NHS organisations and key strategic operations that stayed open during that time, particularly in lockdown 1, many other organisations shut down, everybody went home and demand reduced on the grid. That then had a corresponding impact on price, and prices fell, even to the point of some organisations being paid to take energy off the grid on certain days at certain times. Since March 2020, we saw prices start to steadily rise, and through 2021, we saw a real push on manufacturers who were working through through sort of COVID lockdowns, both in countries like Brazil and China. And through that time, those countries that were in effect focusing on manufacturing, still maintaining steady demand, secured long-term gas contracts. As our demand was so low across the UK and Western Europe at that time, that in effect sucked up a lot of global supply. And as we moved through 2021, through gas injector season, where we typically recharge our storage facilities across Western Europe, we saw that prices continued to rise because of that. As we got to 2022, we saw Nord Stream 2, which was due to be an additional pipeline in between Russia and Germany, cancelled, which had a corresponding impact on the market. The market spiked at that point. At this point also, Russia was amassing troops on the border of Ukraine, and there was concern. Following that, we then saw Russia go into Ukraine, which also caused a lot of concern, and the market spiked at that point. As we went further into last summer, we saw prices come down, but subsequently we saw a few key things which caused this major spike. We saw Nord Stream 1 have issues, both with suggested maintenance, issues with turbines on the pipeline, and subsequently the sort of failure of the pipeline to carry any gas at all. We also saw one of the US's largest liquefied natural gas facilities, Freeport in Texas, have a severe fire, and that caused the global supply of liquefied natural gas, which we're very reliant on as a country in the UK, to be quite impacted. And prices spiked through August and early September of summer 22. Since then, at that point as well, we were also going into autumn, so prices at that point were being impacted by strong demand to fill up gas storage, and there was a lot of concern at that point as we were going into this winter around whether there'd be enough supply to get us through the winter period. Since then, prices have gone into a slight downward trend. So we've seen ultimately a relatively mild winter compared to norms for this time of year. We've seen plentiful supply of wind. We've had good supply from Norway, and we've had French nuclear reactors come back online where they'd previously been struggling. So we have now started to see prices come down. But overall, this is a picture which has been highly volatile and quite turbulent.
Thank you. That's an interesting summary of some of the key challenges and the impact on energy prices and energy availability. How does the turbulence that we've seen in recent times compare to what we might have expected to see historically? Obviously, there have been several exceptional circumstances.
Indeed. Well, I think if we cast our minds back to perhaps the last time organisations were placing contracts, let's say in 2019 or 2020, you would have historically looked at paying a commodity price, so the wholesale gas or the wholesale electricity price here of around 4 to 5p per kilowatt hour, and that made up about 40% of the overall bill. The non-commodity elements, so the taxes, the levies, the distribution costs and supplier costs, would have added another 6 or 7 pence to that total delivered cost. So overall, the rate that was likely to be paid would have been somewhere around 10 to 12p for electricity. And that commodity price particularly was 4 or 5p, which I think people would be quite happy to take these days, given where the market has gone to. If we fast forward that through to what we're looking at now, and remember here that the energy market is a futures market, so at any point on any day, you can look to trade or to secure prices about 5 years out into the future. And we can see that prices are in the next 3 years, somewhere between 120 and 160 or 170 pounds per megawatt hour. So that equates to 12 to 16 pence just for the commodity element. But you'll notice that this chart here shows the prices right out till 2028. And as we get into this period from 26 onwards, what we're seeing is far better value out in the future. So prices here more like between 7 and 10 pence per kilowatt hour. A marked discount against those prices that are currently available in the market.
So I imagine the big question a lot of people will be asking on the back of this sort of data is, what do you think at Inenco, what do you think might happen next? Maybe that's a question for you, Stuart.
Yeah, thanks. Firstly, apologies for the voice, struggling a bit today. But you're right, the key question is what will happen next. The way we look at it is both in the short term and in the medium term. So as Dan took us through, prices have been trending down since the peak of the market in August last year, which is very welcome news. The prices, what's been the main reason that prices have fallen? We've seen periods of cold weather. So in December, you can see through the light lines on the price chart, the spot price went high. But crucially, in the UK, we still received a lot of LNG, and in Europe as well. So the concern going into winter would be, did we have enough storage gas to last us in the coldest periods? And would we be able to land the LNG into UK and Europe? As we kind of went through the end of December, we saw prices did fall quite considerably. And that's because the market's starting to be relaxed. So if the winter period is 6 months starting 1st of October, when we start to go into the first quarter of this year, we're starting to move through the danger zone. Crucially, it's the level of storage that's the risk factor for the market. So as I said before, storage is what we use when demand is at its highest, and it's the bit that makes sure that we balance the system. If we look at the storage levels currently in Europe, then you can see that the level is extremely high versus the norm. We've not taken much out of storage at all, and that's starting to make the market very relaxed, that we will get through this winter without any supply demand issues and therefore any price issues. We go through the quarter means that the level of risk for this winter diminishes as we go through time. So the main variables that we have to face are weather, so temperature, demand, and LNG delivery, so supply. If we look at the weather forecasts, we keep hearing that cold weather may be coming. We see a bit of cold weather, but it's not serious cold weather, and it's not challenging us in terms of demand. The weather forecasts don't look bad for the remainder of the quarter as well. So whilst you can never be too sure about a weather forecast, actually, in terms of demand, we're not expecting to see any kind of huge spikes in demand. We're also seeing that the LNG deliveries are continuing at the high volume and consistently. So our supply-demand situation in this quarter is looking really healthy. As we move out of the quarter and we move out of the winter, then the market then really does breathe a sigh of relief because we've got through the troublesome period. The further impact of that is, Dan mentioned it before, that the main source of gas demand in the summer is normally injection demand into storage. So we fill the storage in the summer, we use it in the winter. But you know, we're heading into the summer in a place that we've never been before, not even in COVID times, where the storage levels will be around 80%. So actually the demand for gas in the summer will be comparatively low to where it has been for us. So again, that reduces not only demand in summer and therefore it's bearish on price during the summer, but it also starts to de-risk next winter as well, because the market's not worried will we have enough gas in storage in time for the start of next winter. So in the short term, what would we expect to see happen? If weather plays out as it is, if LNG continues to be delivered as it is, then we're bearish on price during 2023, and we'd expect to see prices continue to drift down, especially as we move out of Q1 23. So good news in terms of price. Next question is a more of a kind of a medium-term view. Where can prices go? So it's great news that prices are falling, but prices are still very high compared to where we've seen in the past. So for me, a normal market price was around £50 per megawatt hour. Actually, in 2021, we already started to see prices go above £100 per megawatt hour, so doubled from the norm. And they did that before the Russia-Ukraine tension started. So that was on the back of LNG. Prices go even higher with the Russia-Ukraine invasion, peaking at nearly 800 in the summer. The impact of the Russia invasion of Ukraine is that Europe have changed fundamentally where we take our supply of gas from. So we were very heavily reliant upon cheap Russian gas. We're now having to buy gas, having to diversify our energy sources. So as we move forward, we can no longer look back at the old world and say 50p or £50 per megawatt hour is the market norm. We are moving, unfortunately, into a different world. We also looked at a slide before where we looked at the forward price for electricity and gas, and we could see that prices were cheaper year on year. But actually, the price, it took a few years to get below 100, and even 5 years out, the price was still around £80 per megawatt hour. So that premium compared to the old norm, it is still there, and it's still significant. Do we think those forward prices could get lower? I think that's a big question that everybody's got. If you look at the industry long-term price forecasts that look out where they expect the prices to be in each year, so not as a forward price now, but where they expect prices to be when we get into 24, 25, 26, actually those forecasts are higher than the current forward prices that Dan showed before. So there isn't an expectation in the market that prices will kind of return to the 50 level anytime soon. And there isn't, unfortunately, an expectation at the moment that those forward prices we're looking at will get any cheaper. So actually, we might not like the current price levels because they're not as low as we'd like, but in the new world that we're now entering, then those current price levels do start to look as if they may be offering good value.
Thanks, Stuart. And what do you see after that very interesting overview as returning to the health service as the major factors that can influence the price outcome that a trust can achieve, an NHS trust?
Yeah, so I think for me, it sounds very obvious, but it really is. Timing is everything. So if we look at the chart below, it shows the price volatility over the last 5 years. I mean, it's the volatility in 2021, so from low to high, was excessive. Actually, if we put the numbers on for 22, now we finish the year, actually the volatility is off the scale. But even in normal market times, you're looking at a volatility there of 50%. So energy markets have always been extremely volatile, and they'll continue to be volatile, and probably because of the kind of the new world that we're in, that volatility will probably, unfortunately, get worse. So the timing of what you do when you buy is the first major thing that you need to look at in terms of kind of optimizing price. I think one thing that we've learned over the last year is also timing isn't just about commodity, it's also about the non-commodity. So a lot of conversations I've had with NHS Trust recently have been, yes, we're managing the commodity well, and we've protected ourselves against the worst of this market, so great news. But the non-commodity is starting to play a much bigger role as well. So I think it's often overlooked that a number of non-commodity charge lines are actually directly linked to the commodity price. So within contracts, charges such as UIG in gas, shape and losses on electricity, these non-commodity charges have also seen significant inflation as well. So whereas previously you may have just assumed that non-commodities may go up by 5% kind of year on year, that major inflation in terms of non-commodity prices, I think that's caught a lot of people out, because in the media most people were focusing on the commodity price and talking about what was happening there, and therefore the non-commodity to some extent went under the radar. Again, we're in a new world, and if the non-commodity price is getting driven so much by the commodity price, then actually not only making the right timing decisions on commodity is important, but it also needs to be done in non-commodity too. So the kind of risk managed approach to buying has got more complex, and trusts should also start to look at the non-commodity aspect of it too. And then moving on, so if timing is kind of the number one item, then there's a very simple rule for me. If prices are low, then contract for as long as you can. And if prices are high, then you probably want to contract for a much shorter period. So timing is key. Dan talked about the market cycle before, and we'll take a look at the market cycle in a little bit further. But if you are able to kind of understand the market, where you are in the market, then contracting at the right length will actually be the second most important thing you do in order to optimize the price that you pay. We do kind of still occasionally come across organizations that contract on a kind of a rolling 1 year basis. So kind of a very short term outlook. I think what is kind of proven fact is if you do contract in that way, you do contract kind of with that short term horizon, you will pay more than you need to do, and you'll probably pay a lot more than you need to. The other issue with that is the lack of cost visibility you'll have as well. So with the challenge on budgets that we're seeing at the moment, understanding what the costs will be on the commodity and the non-commodity kind of as we move forward is crucial. So not only is contracting for the right period of time critical in terms of price, but it's also critical in terms of understanding the cost and being able to manage budgets around it. And then moving on to the market cycle. So it's my favorite subject, something I like to talk about a lot. What we've got here is the last two completed market cycles. And we spoke earlier about cycles. All markets work in cycles, and the energy market is absolutely no different. The average length of a cycle tends to be around 5 years. Actually, it was always kind of relatively easy to kind of understand where you might be in terms of a market cycle. So the normal price range in the old world may have been from a low of 40 to a high of 60. So, the benefit of hindsight, if you contract for 4 or 5 years at the bottom of each of those cycles, so 2016 and 2020, then regardless of what happens in the market after that point, you can't possibly have paid a lower price than you would have paid by forward contracting at those periods. So understanding where you are in the market cycle is really important. It goes back to the timing. So, we need to time purchasing and contracting at the bottom of the market cycle. And if we can establish the bottom of the market cycle, we need to contract for the medium term as well. The markets, in terms of liquidity and prices, go out 5 years. So the max you can contract for is 5 years. So that does fit in nicely with the length of market cycles. I guess the key question at the moment is whereabouts are we on the market cycle? So I've described that we are in a new world. and that we can't be, so therefore we can't look at the market and say, 40 is good, 60 is bad. If it's 40, by 5 years. If it's 60, by short term, and watch the market fall. We've also kind of reviewed where the current forward prices are. We can see the backwardated, so the cheaper year on year. We've also looked at the long-term price forecasts that suggest actually those forward prices that we're currently looking at are good value. And in the short term, we're expecting prices to hopefully drift down a bit further during 2023. So in terms of where we might be on the market cycle, the last cycle started in April 20. We've definitely seen the spike of that in September 22, so we've hit the high already, and we've started to move down, and actually prices have moved down considerably from where they were in 22. It's a very real probability that, whereas I've described that the market cycles as being on average of 5 years, actually because of the extreme nature of the market over the last 3 years, so COVID in 2020, the impacts on the market, to 2022, Russia and Ukraine, I think we're probably seeing a very short cycle. So we may be seeing a cycle of around 3 years this time. So our expectation is that 23 contracting and kind of buying at these price levels may prove to be good value. Bad value compared to what you're used to paying, but in terms of new world prices, it does represent good value. The key thing I always stress to people is when they ask me to get kind of crystal ball out and like I've done today to tell you what I think will happen, I think we've always got to be very mindful that there is a hell of a lot of risk, volatility, uncertainty within the energy market still. So there are things we can't predict out there. We can't predict geopolitical events which have a major impact on the markets, and we can't predict weather more than a week or so out. So there is a lot of risk. So if these prices are truly kind of good value, then putting in place a buying strategy that protects these price levels. So you say, I'm going to pay no more, and I've also made sure I've made the right decisions in terms of my non-commodity. That's the starting point. So it's protection at these price levels. So if prices go up, then you're protected. There's no risk. So I've painted a picture that prices are good. We've got to accept the possibility that something may happen that is not currently being forecast, and prices could fall as well. So a strategy that works in both worlds is needed. So price protection whilst prices are looking good, but if prices do fall, having the ability to adjust your prices to capture value of a falling market is still very important. So having that kind of flexibility to adapt to this very changing market will be kind of the best way to manage price risk over the next few years.
Thanks very much, Stuart. Many of the issues you've discussed so far between you will have had an impact on any organisation, but perhaps I can ask Dan. Dan, what do you see as the specific challenges facing NHS trusts here?
Well, I think there's a few specific issues in the NHS. One is lack of resource, lack of time. A million competing priorities. Many people watching this webinar probably work in procurement of some type, and actually, whilst the energy market is crazy, so is inflation across any number of other categories. So there is a lot of work that has to go on to manage costs right across the piece, and energy is just one part of it. And there's firefighting, all sorts of the other issues that we've got in the NHS on the back of the issues that we've had through COVID. We also understand from what our clients tell us that what our NHS clients need is a good degree of budget certainty. So whilst we need to achieve the best price possible to minimise the cost of energy, minimise cost in estates and so on, but also we need to know what that is. And equally, the challenge of net zero across the NHS is a real one, and lots of NHS trusts want to be will strike the right balance in between being forward-thinking and making good progress on the road to net zero, and that price affordability. So there is definitely a balance to be had on green aspects. So I think just to reiterate Stuart's points here, really, I think there's a few key things that need to be taken into account there. To face off these challenges, there's the duration that you're going to contract, there's the timing in the market, and equally there's the most important thing here might be getting a good quality of advice to help you make those decisions, help you make those trading decisions and strategy development in the most informed way that you can, and understanding the wider green landscape of how you can best build in the greenest kilowatt hour at the lowest price point, whether that be REGO backed energy or whether that is something else.
Thank you very much to both of you. That was some very interesting points and a fascinating overview, particularly given the huge focus that's been on energy, particularly as it affects consumers, but also businesses in the media recently. It's time for some questions now, but before we get to ones we've had in from listeners, I wanted to ask one. I understand NHS England have been undertaking a review around energy procurement recently. What's your perspective on that?
Yep, so yes, there's been a review at NHS England, along with a wider commercial review of lots of different types of services and products that are procured right across the NHS. And both some of our clients and some of our colleagues have been in those conversations and formed part of that consultation with the wider NHS community. I think that's first thing to say is I think that's a really good thing to do. So I think it's really good that NHS England is stepping in here and looking at this, looking at the best ways for the NHS right across all the different trusts can best act to deliver value for money. So I think that's a really good thing. Second thing to say is that I don't think that the outcomes or the recommendations have yet been made public. So as soon as those recommendations are made public, looking forward to seeing those, looking forward to helping implement those. And in the meantime, though, we speak to a lot of trusts regularly and who've been part of that consultation and who've been in dialogue with NHS England. And I think that there's been a lot of those trusts who, on the back of that conversation, have decided to go ahead and to take a longer term, well-informed strategy.
Thanks very much for that, Dan. In addition to sort of energy procurement and looking very carefully at energy prices and where to get best value and contract duration and the cycles, etc., are there any other things particularly, and I guess there's a whole host of possibilities here, that a trust could do to help control their energy costs?
Sure. Well, I think there's two parts to this. It's probably understanding what actually makes up the cost on one hand, and Stuart started to talk a little bit there about the non-commodity elements and what you can do to minimise those non-commodity costs. But on the other side of things, the old adage, the cheapest kilowatt hour is the one that you don't use, really does apply. So spending as many trusts have already, a lot of time and and energy on how to develop that strategy to reduce consumption right across the estate is a really important one. And that really forms part of the first phase of decarbonisation plans. So whilst many organisations are looking at how do we decarbonise, how do we decarbonise heat in particular, the first part of that strategy is always, well, how do we minimise the amount of energy that we actually need before we look at a low carbon source. So many trusts and indeed organisations like Salix have suggested taking a fabric first approach, looking at how to minimise things like heat loss, and indeed looking at the low hanging fruit, things like investing in controls optimization, looking at building management systems to make sure that they're really helping you control consumption, and looking at those relatively low cost capital projects that you can do to improve the efficiency of major energy users, things like lighting, conditioning, and so on. So yeah, I think it always starts with energy efficiency, but beyond that, really getting the insight on what actually makes up the cost and how you can manage those non-commodities is an important part as well.
Thanks. We're also tasked, of course, with sourcing green energy. What are some of the best options to address that without incurring a significant price premium? Because I know that could be an issue for the NHS.
Yeah, I mean, what we have seen is the drive to buy more sustainably is great. The price for doing that, it has increased in line with the commodity markets as well. So the cost for doing it is increasing. It's a really interesting area at the moment. We're already helping a number of organisations buy more sustainably, and there are a number of approaches that we can take. It can be, as Dan talked about earlier, it might be you take the very simple low cost or lowest cost approach, which is re-go back to energy. For a lot of organisations, though, that won't be sufficient. The other options we're helping organisations with are corporate PPAs. So that's contracting with a wind or solar farm. It might be on-site generation, so solar panels on roofs. It might be private wire networks, so you've got a building next to a field with solar panels which you can connect in, or it might be a combination of all three. So there are a lot of different solutions. There is a cost to them, and the more green you buy, the cost for doing so increases. I think what we're really trying to help organisations understand is what the options are, what's right for them, and what the costs will be. So a lot of the projects that are in play at the moment, if you take a corporate PPA, for example, then you're talking about a contract duration of 10 to 15 years. So that's 10 to 15 years of your kind of annual electricity budget. It's a lot of money. If it's on-site generation, or you might be talking of a 20-year investment. So understanding the costs involved very clearly, what the options are, it's really starting to get people to think about what their options are. I think our experience at the moment is a lot of people are in fact-finding mode, but we're expecting to see a lot of movement over the next couple of years in terms of buying more sustainably. There is a kind of a drive to it in that there's only X amount of new generation that's available coming online. So in order to adopt a greener way of buying, then actually there is a need to move fairly quickly.
That's interesting, thank you. In fact, one of the questions we had in, which I was going to ask, was will you cover PPAs and CPPAs, and how this could support the NHS with greening its electricity supply, which was from one of the audience. I think you've gone into that, unless there's more you want to say on it particularly.
No, yeah, it really is how much you want to pay. That's the key. What we try and help organisations do is to kind of understand the cost of it. Can we help them with their internal investment case to do it on the numbers? Again, it's not the costs aren't going to bring you back down to the old world of £50. So that's the key issue.
Thank you. Somebody's asked, budget certainty is very important to our board. What's the best strategy to follow to achieve that? Quite a difficult question, really, I guess, and a complex one.
It's never been more difficult, and I certainly have had quite a few conversations with trusts boards over the difficulty of it. So there are a number of different things. There is how much energy that a trust will use, and that's really important, because obviously it takes the overall price. It's the commodity cost for it. So we can see prices 5 years out, so we can forecast it, for that length of time. If you've got the right risk management strategy in place, it would say, okay, prices can't go above current levels, so we'll cap them at current prices. Therefore, you've got your kind of worst case scenario. If you can start to bring the price down from that point in time, great. The thing that's caught a lot of organisations out, though, is the non-commodity costs. So non-commodity costs, whilst they went up every year, it was quite vanilla. It was inflationary increases. That's where the surprises are at the moment. So understanding what those non-commodity costs are doing, but also how you control them as well. So you need to be able to forecast them, but also control them. And that's, I think, one of the big challenges in the market. We're also seeing a lot of actions being taken by suppliers that previously we wouldn't have seen. So if we think about the cycle at the moment, in April 2020, then COVID hit, demand went down, prices went down. So suppliers have got a problem where their clients have bought more energy than they're going to use, and it costs less when they sell it back to the market. So suppliers are going to organisations with challenges over volume. Wind the clock forward, then organisations are generally using more energy than that they've bought, and the price is high. So now suppliers have got the reverse problem. As the market cycle moves on again, the prices are falling, they're probably using less, and the price when they sell it back is at a loss. So it's also understanding the consumption and the contract clauses are really important as well. So it's the complexity of it. It's what my costs are, can I control them, and do I understand what the risks are to me as an organisation.
Thanks, Stuart. Just one or two other questions from the audience. One of them was a simple one. You may want to refer to it, but it was slide 6. And it says, what date does your graph on slide 6 actually go to? I don't know whether it wasn't visible, but how recent does that go to? That it was the slide about volatility, turbulent times, I think.
Yeah. It goes right the way through to January. That chart does.
Of this year.
Okay. This year, yeah.
Yeah.
But indeed, the overall movement is downward recently, and One of the things that's really useful that we're able to talk through if and when individual trusts are interested is the pricing as it is to date. So Inenco produce a daily market report, and it's something that we're always more than happy to talk through what the current drivers are and what's going on in the market.
Thanks, Dan. Philip Rees, who actually asked that question, asked another one, which was, what do you say to the commentators who say that decoupling would significantly reduce UK electricity prices? Is this true?
It's not possible. I think we've got to be realistic. There's a very strong correlation between gas and electricity prices because gas is the dominant generation source. It's also what we describe as the marginal generation source. So if you think about solar and wind, it generates when it's sunny, when the wind blows. So that just happens. The nuclear generation is, it has to be on 24/7. That's consistent. So gas is the bit in the middle, and the fact it's the marginal bit, it sets the price. So that's why we've got such a strong correlation between the gas and the electricity price. I don't see a mechanism where you can decouple them. I don't think they're coupled. I think it's just correlated because it's gas is the major generating source of electricity. Has been kind of on a similar note. There has been talk of kind of changing the pricing mechanism in the market because it is based on the marginal source. It's the most expensive source that sets the price for the system. So I think if you were to see kind of market revolution in order to combat prices, then it's I think looking in that area possibly is going to be kind of most effective in terms of kind of a new regime that will kind of alleviate some of the pain that markets are causing.
Thank you. A quick question for either of you, coming from William Miller. Should the energy regulators intervene to control the non-commodity market?
Yes. It was a major issue for Inenco in that all the media was talking about the commodity price. There was no real reference to the non-commodity price. Not only was there no reference to it when the energy bill relief scheme and its successor, the discount scheme, were announced. It only protects the commodity price, and a lot of organisations have found themselves exposed to an increase in the non-commodity costs. And if you contracted in, say, September, October 22, then your non-commodity bill could have gone up by anywhere up to £100 per megawatt hour. Previously, you'd have paid £50 for all your commodity. So it really did cause kind of a problem. It's only a problem whilst the commodity prices are kind of so high. But I think in terms of the way kind of assistance was made available, it could have been done in a better way that gave more protection to the end user.
Thank you. Another question relating to one of the slides, which was the market cycle challenge and opportunity slide. Philip Rees again has asked, were most current deals done around 2021 to coincide with the old 5-year cycle date from 2016 onwards or through?
I think and I can only speak for Inenco, we contracted and bought kind of a huge amount of our volume in April 20. we took advantage of the fact we could see that prices were on the knees. It was it was the COVID crisis, and I think for us it was quite clear that was the opportunity to buy long. So if people kind of bought around that time, then they can be benefited for a price of around £40 per megawatt hour. If prices have been kind of as high as kind of 600 as we moved into winter, then the benefit for doing so was kind of many millions. So I think for me, there was a big drive to contract in April 20. I think some organisations weren't able to commit at the time because they were unsure of what was the impact of COVID was on their organisation, or they weren't sure on their volumes. So you then did see, as the question suggests, you did see a hangover of the contracting through to 21.
Somebody else has asked, Severine Turgi has asked, looking at the graph, it's not clear to me the current cycle has peaked. I think it's the same graph, but it seems to stop at February 21.
Yeah, so the chart, it's really just trying to show the two completed cycles. So it's kind of focusing on those dips in Feb 16 and April 20. If on that chart, if we did extend it, then it actually makes given the extremeness of the prices, it would make that look very flat. So it's quite difficult at the moment to show price charts where you can see the history and the volatility, and you can see where you are now. In terms of where we are in the current market cycle, I think we've definitely peaked in the summer of 22. It was the concern that Russia wouldn't flow the gas to UK and Europe that caused it. Actually, Putin dealt with that for us by not flowing us the gas. So we know we're not getting it. There is no shock. It's not going to can return to those levels, and that our expectation is, based on what's happening at the moment, that we're likely to see the 23 as being a potential the next potential market low, albeit that low is much higher than the lows that we saw in 16 and 20.
Ian France, hello Ian to you, has asked, what's the principal reason for the cyclical nature of the market? Is it as a result of economic cycles?
Economics does play a large part in this. In times of economic strength, then commodity prices, that they are high. Electricity and gas, they are a commodity price. There is a kind of a soft link to oil price, and oil prices being a barometer of kind of economic strength. So you do see that driving it, and I think again you're picking on COVID in 2020, when economics are tough, and you can see the impact it has bringing the price down. One thing I'd say about the energy markets is that there are a multitude of things that can affect prices. So I always say to people, don't just look at kind of one indicator as to what might drive prices, because one year it might be economics driving it. Next year it could be weather. The year after it could be something else. But there is a definite influence of economics on prices.
One question that I'm sure will resonate with lots of people in the sector, particularly estates and facilities managers and healthcare engineers. William Miller's made the point, and it may be a point rather than a question. He said there's, of course, the ongoing issue of the condition of the existing physical infrastructure in healthcare that needs investment to address energy performance. I guess that's an issue that's been prevalent for some time. and it's a question of having the available funding and resource to make some of the improvements you've talked about.
Indeed, yeah, and I think that's really where the heat decarbonisation plans and wider campus decarbonisation plans have really come to the fore and allowed at a board level within the trust to see what the cost is of making campuses and hospitals not just more efficient but also low carbon. How are these buildings going to get to net zero by 2040? There's a lot of energy efficiency work that's needed in the first instance before we even start on the low carbon work, and that has absolutely been, I think, acknowledged by organisations like Salix, who have put in place the public sector decarbonisation fund, where many trusts that we work with have been successful in securing multi-million-pound finance to help address that energy on-site sort of infrastructure challenge that you're right, most trusts do face.
Ian Fransken has asked, what are your thoughts on the use of private wire? How big an impact can this have on addressing NHS needs to decarbonise and manage costs?
It's a really interesting opportunity. First of all, it ticks the box. You're buying sustainably. You're adding green generation to the grid. In terms of the pricing side of a private wire net, it is really interesting because there are two elements to it. Because it's a private wire, it's not just the commodity price that you're looking to manage, it's also the non-commodity price as well. Because with it being a private wire network, then you don't have the vast majority of the non-commodity costs. So the financial case for a private wire can be very interesting, possibly even more interesting than a corporate PPA. So on the face of it, looks really good. I think you need to be really careful about the organisations that you kind of are dealing with, though. So there's a lot of organisations kind of flying in and out of these types of development, and you need to be working with a partner that you can trust, and they're in for the long term in terms of the maintenance and the guarantee of the equipment. So great opportunity, but risks.
Thanks, Stuart. I'm conscious I've got a few more questions. I don't want to completely wear your voice out because I know you're suffering a bit at the moment. Kim Featherston has asked, is it likely that the, in inverted commas, new world prices will increase interest in renewable energy and perhaps micro-generation by NHS trusts? Is it likely the government will encourage this through grants, etc.?
I think the new world prices probably make the economics of renewable generation easier. So I think that's helpful. The renewable generation, though, has increased in price on the back of the new world prices as well. So it kind of has helped, but also it's added quite a bit of cost onto it. I think the challenges that people face still are it's going to your CFO and asking for a couple of £1 million multiplied by 15 years with quite a bit of risk attached to it. So I think the challenge there is that it's still presenting the financial case. So I think it's got the right ingredients, and I think yes, we expect that if the government is serious in greening the grid and it's serious in reducing our kind of energy dependence on the imported sources, then incentives will be good. But it goes back to the numbers and getting the financial case right.
I think just to add to that, I think actually the government hasn't really subsidised sort of solar panels, as a for instance, since about 2015, when the feed-in tariffs were scrapped, and lots of trusts have panels from that kind of an era. But I think, well, looking back through that time, actually it was acknowledged that if trusts had spent that kind of money at the time on energy efficiency, that they would have made massive cost savings through that period. So I think the first focus has always got to be on reducing demand and reducing consumption before you look at then where you're going to get that from. And yes, on-site generation and things like private wires are certainly a good place to start, but making sure that you've got a robust due diligence and feasibility on that, and how that integrates with your shape of demand, shape of consumption, and so on, is a really important piece of the planning work that you need to do.
Are you okay to take a few more questions?
Of course, yeah.
Sure.
We've got another one. Can you comment on the so-called green tariffs available from some electricity suppliers? Are they really green? And how do you account for the carbon emissions with these tariffs?
I suspect from the question there's some degree of cynicism behind it.
Well, I know the questioner. I know that he's very expert and a very keen observer of the market. So yeah, interesting.
Right. Yeah. I mean, the market's had problems in terms of the claims that organisations, suppliers were making. Amount of, famously, there was more kilowatt hours of green energy sold than was generated, and therefore, the REGO system, retiring the REGOs, is kind of meant to kind of clear that up. I think if you're buying a green tariff from a supplier, you don't really know what's behind it. So I suspect you would find, that there is, for example, kind of a big chunk of biomass in there. So if you're trying to buy in the right way, then kind of the supplier-backed tariffs aren't going to help you achieve that. I think if you're serious, then it's looking at the corporate PPAs. It's actually being able to identify the generation source. You're really looking for it to be solar, wind, hydro. What's the source? Is it, have you helped the additionality argument as well? I think that's very different to kind of the green tariff. And to be honest, I think vast majority of organisations kind of have that green tariff now anyway.
Thank you. One more question. This is from Paul Lewis. I understand why the cost of gas has been so volatile, although the correlation between gas and electricity relates to nothing more than a formula that is applied by the pricing mechanism for electricity. Do you know how this correlation is justified?
It goes back to the fact that gas is the major generating source and also the marginal pricing source. So that's why there's a correlation, because you burn the gas to generate the electricity. In terms of trading on the markets, then there is something out there that is the spark spread. It's the difference between the gas and the power price. It is about the efficiency of the plant. Actually, that whilst there is formulas, that you calculate it. What you're doing is you're taking the cost of the gas through to the electricity, and it's the economics behind it. So I know there's a lot of questions being asked by organisations and people at the moment about are these price rises genuine? But the link between gas, electricity price, it is there.
Thank you very much. I mean, as a consumer of electricity and gas, like most of it, I've seen the impact personally, but for NHS trusts and these very large healthcare providers, the ramifications are massive, really. So I'd like to thank you both, Stuart and Dan, for a fascinating presentation. Some great questions from the audience, and thanks for your very comprehensive look at a highly topical subject, which is not going to go away in importance in the near future. Thanks to our audience, but I hope you all found it interesting. And thanks again to our hosts. Cheers.
Thanks, everyone.
Thank you.